Okay, let's talk about something that makes pretty much everyone nervous, the IRS audit. But don't worry. The whole point of this explainer is to pull back the curtain on what actually gets the IRS's attention. And we're going to give you some clear, practical strategies to stay off their radar, all based on insights from someone who used to be on the inside, a former senior auditor for the IRS.
Ugh, this sentence, just seeing it is enough to make your stomach drop, right? It's the kind of mail nobody wants to get. It's the official start of a process that can be stressful, time-consuming, and yeah, expensive. But what if I told you that a lot of the things that trigger this letter are actually well-known and, more importantly, totally avoidable?
Okay, so check out these numbers. For most people, the overall chance of an audit is actually pretty low. But look what happens when your income goes up. The risk jumps a lot. For folks earning over $1 million, and it goes up even more for those over $5 million. But here's the thing, it's not just about being rich. It's really about complexity. The more complicated your return is, the more likely it is to get a second look.
So, here's our game plan. We're going to start with who gets flagged and why. Then we'll dive into the biggest red flags one by one. Stuff like income mistakes, traps for business and property owners, and deductions that get put under the microscope. And then we'll wrap up with what to do if that letter does show up in your mailbox.
All right, let's jump right in. And remember, what we're about to cover comes straight from someone who spent 8 years as a senior auditor. They've seen it all, and they know exactly what makes a tax return stand out from the millions of others.
So, what's the common thread here? It's that word again, complexity. If you own a business, you're a freelancer, or you have a lot of investments, your return just has more moving parts. That means more chances for errors or things that look odd, and that's what gets the IRS's attention. So, even if you're not pulling in 7 figures, these red flags are definitely still for you.
Okay, let's get into our first major category of red flags. And no surprise here, it all starts with income. For the IRS, finding mismatched income is like shooting fish in a barrel because their computers already have all the data they need.
This is the big one. See, with your regular W-2 job, your taxes are withheld automatically. But what about all that other income? You know, the money you made selling some stock, the interest from your savings account, cash from a side hustle, or rent from a property. The IRS gets a form for almost all of that too. If you forget to report it, you're practically guaranteed to get a notice.
And this right here shows you the paper trail. Your bank, your stockbroker, that company you did some freelance work for, they all send these 1099 forms to you and to the IRS. The IRS computers just play a matching game. If the numbers they have don't line up with what you reported, boom, a flag goes up. So, the absolute #1 rule is to wait until you have every single one of these forms before you file.
All right, here's another thing that can get their computers buzzing. Let's say last year you made $90,000, but this year you're only reporting, say, $40,000. Or maybe it's the opposite and you had a huge windfall. That kind of big swing can make an automated system raise an eyebrow.
So what do? It's actually pretty simple. You just tell them the story. You can actually attach a short note to your filing that explains why there was such a big change. You know, I lost my biggest client this year, or I sold a large investment. Just explaining the why behind the numbers can answer an auditor's questions before they even have to ask.
Okay, let's switch gears and talk about another area that's full of potential red flags: businesses and properties. If you're self-employed or you're a real estate investor, you're going to want to pay close attention here.
Look, it's totally normal for a new business to lose money for a year, maybe 2. But when you're claiming losses on your Schedule C year after year after year, the IRS starts to wonder, is this a real business or is it just a hobby that you're using to write off your expenses? They want to see a genuine profit motive. If they decide it's a hobby, they can disallow all those losses you claimed.
So how do you prove you're the real deal? Records. Meticulous, organized records. You need to be able to document every single dollar that came in and every dollar that went out. And don't just keep them for a year. The magic number is 7. You should hold on to all those business records for at least 7 years. This is your absolute best defense.
Now for something a bit more specific, but wow, the stakes are high. Estate tax returns get audited a lot. And the #1 reason is the valuation of assets. I mean, it's easy to value a share of stock, there's a public price. But a family business, a unique piece of art, a commercial building? If the IRS thinks your valuation number looks too low, you can bet they're going to come knocking.
The best defense here is a good offense. If you're handling an estate, you have to build a rock-solid, defensible valuation from day one.
Don't just get one appraisal for something big and hard to value, get 2 or even 3 from qualified independent appraisers. This shows the IRS you did your homework and gives you powerful evidence to back up your number if they ever question it.
Let's move on to the area where so many people get tripped up, deductions. We all want to lower our tax bill, right? But the IRS knows that certain deductions get misused all the time, so they watch them like a hawk. So we're going to zoom in on 3 of the most common deduction triggers. First, charitable donations that just seem way too big for your income. Second, claiming losses on a rental property when you might not actually be allowed to. And third, the home office deduction, which almost everyone misunderstands.
The IRS system knows the average charitable donation for every single income level. If your giving is way higher than your peers, it can trigger a review. On top of that, there are hard limits. In general, you can't deduct cash donations that are more than 60% of your adjusted gross income, or AGI. And for property, like stocks, that limit is even lower, at 30%.
Oh, this is a huge one. So many landlords think that if their rental expenses are more than their rental income, they can just subtract that loss from their regular salary. But nope, it is not that simple. The rules are actually super strict. To claim those kinds of losses, you usually have to be what the IRS calls a real estate professional or have an AGI under a certain amount and be actively involved in the management.
Let's be crystal clear about this one because so many people get it wrong, especially with remote work being so common. If you are a regular W-2 employee who works from home, you cannot take the home office deduction. I'll say it again, you can't. It doesn't matter if your company requires you to work from home. This deduction is reserved only for self-employed people, freelancers, business owners who use a part of their home exclusively for their business. So we've covered a ton of ground on how to prevent an audit. But what if after all that, the letter still shows up? Let's talk about what to expect and, more importantly, the right mindset to have. First thing to know, not all audits are the same big, scary monster. The vast majority are actually what's called a correspondence audit. It's all done by mail, and they're usually just asking for a missing document or to clarify one little thing. A step up is an office audit, where you go to an IRS office. And the most serious is a field audit, where an agent actually comes to your home or your business.
And that brings us to what might be the single most important takeaway from all of this. You can hire the best accountant on the planet, but at the end of the day, it's your signature on that tax return. The legal responsibility for everything on it rests with you and only you. That's why it is so critical to actually review your return before you sign it and to ask questions about anything you don't understand.
So, I'll leave you with this final question to ask yourself. If the IRS were to ask you about your return tomorrow, could you provide documentation and a good explanation for every single number on it? Is it all fully defensible? If the answer is yes, then you've done your job. You can file with confidence, knowing that you're prepared no matter what.